In this video, I'm going to teach you about debits and credits and explain the double entry accounting system. In my prior video, we talked about accounts, and the basic element of account is the T account, right? And there are three parts to a T account: the account name, the left-hand side of the T account, which is a debit, and the right-hand side of a T account, which is a credit. Now, the shorthand for credit is CR. The shorthand for debit is DR. Now, you're probably thinking, well, I don't see an R in debit. Why would it be DR? Well, the terms debit and credit are derived from the Latin term debere and credere. I don't know if I'm pronouncing that properly, but that's kind of where it's from. It's from Latin. So DR will not stand for doctor or drive. In accounting, DR stands for debit. Now, this kind of drove me crazy because I was trying to understand this debit and credit system. So I went to Webster's dictionary to get a definition of a debit and a definition of a credit. And you know what Webster said in the dictionary? That a debit is the left-hand side of the T account and the credit is the right-hand side of a T account. That didn't do me any good, but I have a method and a way of teaching you that it's going to make sense to you, okay? Now, we use a double entry accounting system where that, as I just said, the debit is the left-hand side of a T account and the credit is the right-hand side of a T account. And this is important. For every debit, there must be an equal credit. Now, let's say that the owner invested $5,000 into the business. Well, we know that if the business receives cash of $5,000, well, cash is increased. Well, in the debit and credit system, assets are increased with a debit. So we would put that increase in cash on the debit side of the cash T account. Now, on the other side of the equal sign, both liabilities and stockholders' equity are increased with credits. So in our example, well, who has claims to that cash? Well, the owner invested it. So the owner has claims. So we're going to increase his common stock account. And to increase common stock, you're going to credit. So notice that we have an equal amount of debits and an equal amount of credits. Now, in traditional accounting, this is how they teach it to you. They say that on this side of the equation, right, assets are increased with a debit. And if assets are increased with the debit, then they must decrease with the credit, okay? Now, on this side of the equation, liabilities and equity, both of these are increased with a credit, right? Liabilities is increased with a credit. Equity is increased with a credit. And you might ask yourself, well, what do they mean here by normal? Well, they're just saying that the normal balance is the side that it increases on. So in assets, the normal balance of an asset is a debit. The normal balance of a liability is a credit. This drove me crazy as a student. And it wasn't until I went to Fresno State and took this really intelligent professor named Torben Thompson. And he had a PhD in accounting and another PhD in physics. He was way out there, but he did help me understand this debit and credit thing. He just said that, you know, this double entry accounting is nothing more than sandbox accounting. And he said, do you remember when you were like in kindergarten, you'd go play in the sandbox? That's what we're going to do right now. And he just said, let's say that we're in the sandbox. That hill that you see here, that's a debit. By definition, the debit is the hill. And then the credit is the hole. And basically, where did this hill come from? Well, it came from these holes. Okay, we have $1,000 a debit. Well, 600 credit came from this hole, and the 400 credit came from that hole. So together, these two make up the hill. Okay. Well, how does that work? We received $5,000 cash from a bank loan. Well, if we get a bank loan, we owe money, right? Well, we're going more in the hole. I like to think of it that way. So we've got a hole going here because now we owe $5,000 in notes payable. So we increase the liability notes payable with the credit. Now we receive cash of $5,000. And remember, assets are debits, right? So we have a debit of $5,000 here. So where did this $5,000 hill come from? From this $5,000 hole. Okay, so I really like that. At least it's better than, debit is the left-hand side of a T account, and the credit is the right-hand side of a T account. Now, what does it look like in real life? They say this: when we receive cash of $5,000, we're going to debit cash by, putting the $5,000 on the debit side. And then we're going to increase notes payable by crediting it on the credit side of $5,000. And debits equal credits. All right. How about this one? Paid $1,000 cash on the bank loan. Okay. So if we pay cash, well, what's going to happen to our hill? Well, it's going to get smaller, right? Because we're going to be crediting cash. What's that look like? Minus cash. We're going to take that, credit the hill, and where's that sand going to go? It's going to fill up the hole. That debit makes our hole less. We're less in the hole. Isn't that interesting? So we're going to credit cash of $1,000, and we're going to debit notes payable for $1,000. What's interesting is that debit decreases the hole. It decreases our liability, right? Our hole isn't as deep anymore. We're not in the hole as much anymore. Well, what does that look like traditionally? Well, if we pay cash, we're going to credit cash of $1,000. And when we want to reduce our payable, our notes payable, we're going to debit it. Remember, why is a debit decrease notes payable? Well, you're filling up your liability hole. That's how it kind of works. That is as far as I'm going to go with this hills and hole thing. But I thought it was pretty cool to think about this instead of just thinking, well, here's the debit and here's the credit and not knowing what that means. All right. Now, I remember this graphic so well in my accounting 4A decades ago. And it kind of overwhelmed me because basically you have to memorize all of this. But can I tell you something? And I'm not pulling your leg. I taught this to my 5-year-old daughter who's in kindergarten. And you're saying, Tuttrup, your stories are getting big. No, I did. And one of my classes said, no way, she couldn't do it. And I just say, way, she did. And my class said, well, why don't you bring her in? Well, it was an afternoon class. So I actually had my wife bring in my daughter. And she's little. She's so little that her head just peeps above the desk. I go, Tennessee, that's her name. Tennessee, how do you increase a liability with a credit? Tennessee, how do you increase an asset with a debit? How about revenue with a credit? All of a sudden they go, ooh, can your 5-year-old daughter tutor us? Yes, she can, but I'm going to tell you how she did it. There's a method to this. You know, with all this craziness here, I noticed that there were three main accounts that increased with a debit: assets, dividends, and expenses. And I can remember that by the slogan ADE, ADE. Everything else is increased with the credit. So my daughter really didn't know the double entry system, but she knew that if I said asset, well, assets increase with the debit, right? If I said, how about revenue? Well, revenue is not part of AID, so that must be credit. Okay. So what I'd like you to do is we're going to go over the ADE handout, and I ask you to bring it to the session. And so once you get it out, and we'll go for it. So we're going to go ahead and do the ADE handout, and then we'll do Quick Study 2-4 and Quick Study 2-5. Okay. Now, for your enjoyment, I put this handout in sections. And so the first section is just ADE. A stands for assets, D stands for dividends, and E stands for expenses. And these are the three accounts that are increased with a debit. The rest are increased with the credit. So write that down. Okay, let's see if you got it. Indicate whether each of the following types of accounts would normally have a debit or credit balance by circling either the debit or credit. When I say normal balance, I'm saying what side does it increase on? Normal balance just means what side it increases on. Let's go through these. Assets. Is that part of AID? Yes, it is. It's a debit. Liabilities. Is that part of AID? No, it's a credit. Common stock. Is that part of AID? No, credit. Revenues. Is that part of AID? No, credit. Expenses. Is that part of AID? Yes. Remember, A, assets, D, dividends, E, expenses. Expenses is part of AID, so you're going to debit. How about dividends? Yes, ADE, dividends is part of AID, debit. That's how my daughter did it. And I'll say that this AID thing is going to help you for, maybe 3 to 4 weeks. After that, you're going to have a lot of experience and you won't need this anymore. But as you do your transactions and all your homework, I think this is going to speed up the process for you. Now, the third part of this handout is dealing with the T accounts. And we're going to put the side that it increases and decreases certain categories of accounts. Let's start out with assets. Assets are part of AID, so they increase with the debit. So put the plus on the debit side. Now, if assets are increased with a debit, they must decrease with the credit. How about going to liabilities? Is liabilities part of AID? No. So you increase it with the credit. Well, if you increase liabilities with the credit, you must decrease liabilities with the debit. Common stock. Is that part of AID? No. So you increase it with the credit. Now, if you increase it with the credit, you must decrease it with the debit. Revenues. Is that part of AID? No. So you increase it with a credit. You decrease it with the debit. Okay. Expenses. Is that part of AID? Yes. So you increase it with a debit. So you must decrease expenses with the credit. And finally, dividends. Is that part of AID? Yes. So you increase it with the debit. you decrease it with the credit. Okay. Let's try quick study 2-4 on page 67 of your textbook. So I just took the liberty of putting this in here. And for your review, I'm going to give you the answers and I'll talk about it. There's the answers. Now, in quick study 2-4, we're going to identify the normal balance, either debit or credit, for each of the following accounts. Rideshare revenue. Well, is revenue part of aid? No. So it's increased with a credit. So under A, put credit. B, office supplies. Now, office supplies is an asset, okay? So is assets part of aid? Yes. So we are going to debit office supplies, right? Office supplies is an asset. It's part of aid, so we debit. Cash. Well, cash is an asset. So is asset part of aid? Yes. So we're going to debit cash to increase it, the normal balance, right? Wages expense. Hey, is expense, is that part of aid? Yes, it is. So we're going to increase that expense with a debit. E, accounts receivable. When you hear the word receivable, you know it's an asset. And asset is part of aid, so you're going to increase it with a debit. Prepaid rent. When you hear prepaid, you know it's an asset. And asset is part of aid, so you're going to increase it with a debit. And there you go. G, wages payable. When you hear the word payable, you know that's a liability. Well, is liability part of aid? No. So you must increase it with the credit. So G, credit. Building. Well, we own the building, so you know that building is an asset. And assets are part of aid, so you're going to debit building to increase it. So H, debit. Finally, unearned revenue. When you hear the word unearned, you know it's a liability. Okay? So it's a liability. Is a liability part of aid? No. So you must increase it with a credit. So one thing about this video is kind of nice. You can always stop the video and think about it, or if I'm going too fast, rewind it and do it again. So that's kind of cool. But now I'd like to go ahead and do quick study 2-5 on page 67. And here it is. Now, this one's a little more difficult because we want to indicate whether a debit or credit decreases the normal balance. So we want to know the side where the account is decreased. Okay, here's the answer right here. Here we go. Interest payable. Well, you hear payable, you know it's a liability. Okay, so it's not part of aid. So you know you increase interest payable with the credit because it's a liability. Well, if you increase it with the credit, you must decrease it with a debit. Okay. Accounts receivable. You heard receivable, that means it's an asset. Okay. We know that we debit assets to increase the asset, right? So now we don't want the increase, we want decrease. So if we increase it with a debit, we must decrease it with a credit. If you increase an asset with a debit, you decrease it with a credit. Let's do prepaid insurance. When you hear the word prepaid, you know it's an asset. Well, you increase an asset with a debit. So you would decrease the asset with a credit. D, buildings. Okay, buildings, that would be, we own the building, so it's an asset. We increase assets with a debit. If we increase the building with a debit, we must decrease with a credit. D is credit. E, accounts payable. Okay, you hear the word payable, you know it's a liability. Okay, is the liability part of aid? No. So it increases with the credit. So it decreases with a debit. There it is. And finally, land. Well, we own the land, so you know it's an asset. And we know that we increase assets with a debit. So we would decrease the asset with a credit. Well, there you have it. So that pretty much does it for this video. I'm looking forward to seeing you in the next one. Study hard. Bye-bye now.